All right. So good morning, everyone. Once again, officially, thanks for being here. Thanks for being on time. All right. So last week Saturday it was Carnival Saturday, and you guys asked for the replay of the item to just be sent, and I was happy to oblige. All right. So today we're back at it, and we are actually in module 3 now. So we're closing in on the end. Right. The end is in sight. All right. So today is the 8th. Right. So I have this topic for this week and next week, budgeting. Let me just take a look at what I have planned for budgeting real quick. All right, budgeting 2024. Right, so we have 1, 2, 3. We have 4. Oh, wow, 4 days of budgeting. That's going to leak into April, right? So 1, 2, 3, and then 4. Right, and that's the day after school ends. So we could even maybe talk about doing some extra sessions somewhere in the middle there. Right, standard costing and variances. Let's see what 2024 had. Right? I did 4 days as well. No, that's 2022. Okay. Oh, I did day 1. Okay. All right. I guess I'll figure that out. But yeah. So things will be covered, right? And then the last topic that we have to do is capital budgeting, right? That one I think is about 2 or 3 days. Yeah, just 3 days. So we will be able to cover all of this stuff by May for sure. All right. And then we could look into seeing how best we could add some sessions before the exam to kind of bring everything together, right? But in the meantime, between time, we have some stuff to do, so let's get to that stuff. Okay, right. So the topic we're going to start today is the first topic in module 3, which is called cost volume profit analysis or break-even point analysis, right? So that's called BEP or BEP analysis, right? Okay, so this is actually one of my favorite topics on the syllabus because it's a bit more math-based. Now, I'm not saying that to frighten anybody because I know some of y'all are not huge fans of math, but I would encourage you to, let your brains be tickled a little bit, hopefully, and we'll go from there. Now, in CVP, so variable or marginal costing principles will be used, right? What I mean by that is contribution. We're looking for a way. Which is equal to revenue minus variable costs. Okay, cool. So what we're going to do, we're going to just jump right into it. So I'm going to be typing with some of these things today. I'm going to be writing and drawing in other parts of it. And everything will be compiled and sent to you all at the end. Right. Of course, if you have any questions as we go along, please feel free to ask. I know some of you would have encountered this in school or class already. And yeah, just a little point to note. I seem awake right now. Because we went to bed late last night. My wife was doing some work, as was I. We went to bed after midnight, almost 1, and of course the babies got up a couple of times, and by 5:30 I was up and about. So I had a few cups of coffee and I want a cup of tea. So if at any point in time I seem to be kind of drifting down, or if I say anything that does not make sense, or I do something like I type something and it's definitely wrong, any typos, just kindly bring my attention to it. I don't want to give you all wrong information or type anything incorrect, right? So yeah. Okay. So as we know, people start a business, and one of the major reasons they start a business is to make a profit. We have a very simple formula of profit, which is revenues earned minus expenses incurred, and that gives us profit. All right. Now we could also replace the word expenses with the word costs. Right. So revenue minus costs is equal to profit. Now we're going to abbreviate a bit more, and we're going to use TR for total revenue and TC for total costs, and that's equal to profit, right? So all I have here so far is the same idea or the same concept, just expressed in slightly different ways. And now we're going to dig into it a bit more. All right. Now, as we know, total cost comprises, like I said above, we're using contribution or variable costing approach. But even without variable costing, we know that that classifications of costs, that they are fixed costs and they're variable costs, right? So total revenue minus, sorry, that wasn't supposed to be there, right? Okay, hold on. Right. So we're going to do fixed costs variable cost plus fixed. So variable cost plus fixed cost equal to profit. All right. So again, nothing new, or it's a little different. All I did was expanded this into its components, variable cost and fixed cost. Right. Now, when we drop the brackets, so total revenue, so you're minusing all of your costs. So you're minusing variable costs and fixed costs. And if you kind of group together these first two things here, that's where this comes into play. Total revenue minus variable cost is contribution. So contribution minus the fixed cost is equal to profit. One second, let me just click a button on this side here. Oh, thank you, Sarah. I appreciate it. Good morning to you. Alexis, what's up? Right. Now, we have that, and let's go on to the. So what we're going to do here is we're simply going to, as they say in regular, what you call it, regular maths, we're going to carry the fixed costs across to the next side and change minus to plus. So we're going to add fixed costs to both sides, right? So basically what we're saying here is that contribution is equal to profit. I'll use P for profit, right? Plus fixed costs. Whoa. Oh, who's it? Oh, look, Liana. All right, let me just let Liana in real quick. Hi, good morning, Liana. How are you doing? Good to have you on. All right. So we didn't get too far. This is what we're doing. So today we have started module 3 officially, right? We are dealing with cost volume profit analysis, or CVP analysis, also called break-even analysis, all right? Or break-even point analysis. The first thing I said was that we're going to be using some marginal costing principles, specifically with reference to contribution, which we met recently. And we know contribution is the total revenue minus all the variable costs. So we just started with revenue minus expenses is equal to profit. So that's a formula that we should know, right? Profit is the difference between the money you make and the money you spend. Revenue being the money you make, expenditure being the money you spend. So revenue earned and expenditure incurred in the creation or generation of the revenue, right? And then we just simply swapped, instead of using the word expenses, we use the word cost. Because, I mean, we're doing cost accounting, right? Right? So, and then I swapped some abbreviations. So TR is total revenue, TC is total cost. So all I'm doing here is just changing the appearance, right? So the concept is staying the same. Then we kind of split total cost into its components, variable cost and fixed cost. And then you kind of drop the brackets, and we could see that we are subtracting all the costs from total revenue, right? And then this is where the what you call it, the marginal or variable costing concept of contribution came into play. So we saw that we have total revenue minus variable costs, and it harkened back up to here, right? So let me just kind of put a little arrow thingy there. Let me put this, that, right? So total revenue minus variable cost gave us contribution. So this line became contribution minus fixed cost. And then what we did is we simply added the fixed cost to both sides, and this is what we got, right? Okay, so I would like to call everybody's name, but then that would take a little while. So ladies and gents on Google Meet, if you guys are good with what I have so far, just kind of give me a quick G in the chat. If you need me to re-explain, I'll go over it again, right? If there's a specific part given trouble, you could let me know, and I could kind of zero in on that part. And again, if you have any questions at all, please feel free to let me know. It's not a problem, right? We're here to understand, right? Because as we go down the line, we're going to get a little more involved. It's not going to get harder. It's just I'm going to have a little more maths. And again, I'm not saying that to frighten. I'm just saying that to let you know, just in case you don't have a great relationship with maths, which I wish I could help you with. So hopefully this might. I don't know. All right. So let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10, 11, 12, 13. Okay, so the next 3, you all will hopefully let me know at some point. And you all could always message me directly on WhatsApp. You know what? Let me just respond to my wife real quick here. She sent me a video from Instagram of apparently, so somebody on Instagram is using AI very interestingly, and they use my face on one of my videos, and they kind of did over the mouth and the audio and made it look like I was promoting their business. So I had to kind of comment on it and say, "Hey, this is not me," and I reported the post too. Anyhow, we'll leave that for now. We have things to do, and I could get back to that at some point. Hold on, I'm trying to send a picture in the chat. Right, you all seeing that stuff relatively well. Let me just check and see if anybody on this side. Okay, cool, no problem. Right. Okay, so now let's dig into this a little bit more, right? So I just had to pick any chat, so I'll hold it about here. If anyone needs to scroll back up a little more, let me know, right? Okay. Now that contribution is total contribution, right? And just like with revenue, with revenue, you can have a selling price per unit, which is the revenue per unit. So let's give it some numbers, right? So let's say you were selling your items, let's say you bought a bunch of pens and you were selling each of the pens for $10, right? If you sold 100 pens, your revenue earned would be 100 by 10, right? So $10 is the price, 100 is the quantity, price by quantity, 10 by 100 is 1,000. And a similar calculation can be used to calculate total contribution. We can find the contribution per unit, which, as we know or should know, is selling price per unit minus the variable cost per unit, all variable costs, and that gives us the contribution margin per unit. So what we could do is we could find we could rewrite the above equation, changing contribution into so number units sold multiplied by UCM, which is something I'll put it below. That's unit contribution margin or contribution margin per unit, right? So number of units sold multiplied by the contribution margin per unit will give us total contribution here, all right? All right, so UCM is equal to unit contribution margin. We'll put that one in a different color. How about that? Let's put it in this color here. Right, okay, cool. Now, right, lovely. Okay, so now what we're gonna do is, if you wanna find the number of units sold, we could divide by the contribution margin per unit on both sides of the equation, right? So the number of sold is equal to, so the profit plus the fixed cost, right, divided by the unit contribution margin. And we have another little modification to make here, right? So the number of units sold, right? So profit plus the fixed cost. Oops, sorry. And the unit contribution margin, like we said, is the contribution margin per unit, and we can do that calculation by getting the selling price per unit, selling price minus the variable cost per unit. Right, so the number of units sold the arrow. Units sold is the number of units required to be sold to earn a target. Right. So what we've done here, again, we simply started off with a very simple concept that everybody should know, and we just kind of modified it slightly, line by line, and applied some variable costing principles until we got to this point here. So what this particular formula is telling us now. Whoa, no, that's not what I wanted to do, right? So what this formula is telling us now is how to calculate the number of units that we need to sell to earn a particular profit. So if you want a profit of, let's say, $1 million, and you know your fixed costs, and you know these other things, the selling price per unit and the variable cost per unit, if you know those things, then you can calculate the number of units you have to sell to earn that profit. Okay? All right. Okay, I'm going to send a picture of this in the chat as well. right? Just trying to space it and piece it. So that we're not moving too fast or too slow. We're not cramming too much at a time, right? So the slightly better term to use instead of number of units sold would be sales volume, right? And we will get to that as a matter of fact, right? Okay. um, hold on. So I have a little separator line there. All right, cool. So this is where we are going to get into a little bit of the, well, sorry, we already got into it, so we're gonna continue, right? So we have some more stuff to kind of tack onto this, right? So if we want, so the first formula, right, that we're going to talk about, which we have above there, is the number of units sold to earn a target income or target profit, right, is equal to, right? Sorry, where did I go? Right, so it's that same formula, but what I'm going to do, I'm just going to put a couple of different things. So target income plus fixed costs all over UCM, which is unit contribution margin, right? Again, unit contribution margin is just how we say contribution margin per unit. They mean exactly the same thing. It's just, I guess, a matter of preference, right? Second formula, the second thing that we're going to talk about is that the break-even point. Sorry, that's Bream. I don't know how I got Bream, right? Yeah. So the break-even point. Oh, okay, cool. Break-even point, right? So break even is where we make zero profit. It means basically where the total revenue earned is equal to the total cost, right? So the break even point, right? So this is where, I don't know why it's not, okay, right, where target income is 0. Right? And then, of course, target income is equal to total revenue minus total cost. Yeah, guys, I don't know why it's lagging so bad because I'm typing this stuff and it's not coming up until it just kind of showing up all at once. Right? So if target income is total revenue total cost, right? Sorry. This implies that total revenue is equal to total cost. Yeah, okay. Hey Nikki, how you doing? Yeah. 1 second. Let's see what's going on here. Oh, okay, right. So why is it doing that then? Doesn't have anything else going on. Okay. Just give me a second. Let me close off. Let me just close off a browser here. I need that. I guess I could close this off. I don't think that would be eating up a bunch of. Get rid of that too. Yeah, I don't know why it's doing that. Anyhow. All right, cool. So let's proceed. All right. Hey, good morning, Julia. How are you doing? Good to have you on. All right. So we started talking about break-even analysis today, CVP. So we just kind of I showed how we got to the particular formula we're going to use. All right. I sent some pics in the chat as we go along. I could always, I guess, watch back the first 10 to 15 minutes of the replay. So we're down here now, right? So the number of units that we need to sell to earn a particular income is given by this formula here, where so target income or target profit plus the fixed costs divided by the unit contribution margin. So unit contribution margin is contribution margin per unit, right? And the contribution margin per unit is the selling price per unit minus the variable cost per unit. So that's basically where we are. And then we're talking now about, so, okay, so the break-even point is where the target income is 0. So where your total revenue is equal to your total cost, right? So if total revenue is equal to total cost, it means that you have no profit, right? And that's what we talk about in terms of breaking even. We made neither a profit nor a loss, right? So the break-even sales volume will be given by the formula, right? So fixed costs divided by unit contribution margin, right? Because the target income would be 0, right? So it doesn't make sense to write 0 plus anything because that doesn't really add any understanding or any depth to what it is we're doing. I mean, maybe you might argue, well, it shows that the item of target income is 0, so it does kind of act like a placeholder. But conventionally, we don't. Sorry. Yeah. Conventionally, we just put that, right? So fixed costs divided by contribution margin, unit contribution margin, or, right, fixed costs divided by selling price minus variable cost per unit. Right? So either of those formulae will do. They mean exactly the same thing, right? And most times they mightn't give you the unit contribution margin outright. You will probably have to calculate it, right? Right. Hey, morning. How you doing? Sorry, join. Well, this is keep accounting. I know you were on for the CSEC maths, so I don't know that this would be in your wheelhouse, so it's not a problem. But thanks for stopping and saying one. Have a nice day. Okay, cool. Right. Right. So now, right. So the target sales revenue okay. Yeah. Yeah. So short of stopping to do a full restart and all kind of stuff, which I don't think we have time for. I mean, technically we do because I looked at this stuff for today. So we have some slack built in, but we would rather not have to use that, right? If it gets cumbersome and annoying, then yeah, I'll have no choice but to do a restart, right? Anyhow, so okay, so we have the number of units sold or the sales volume. I mean, the number of units we have to sell. Oh, thank you. Yeah, to earn a specific income. A break-even point is where you make neither a profit nor a loss. So your net profit is 0, which means total revenue is equal to total cost, right? And the break-even sales volume, as in the number of units, right? This is volume refers to the number of units. Wow, okay, that's realistic again, right? Break-even sales volume, number of units is equal to fixed cost divided by unit contribution. Because again, this item here would have disappeared. It will become 0, so it will disappear. And you could also write this formula as this one here. Now, the target sales revenue. So the revenue is the money. So as we saw earlier, to find the money, total money, you'll take the number of units you sell and multiply by the money you make. All right. So the target sales revenue here, what you would do is you would take this item. This is the number of units, right? See, number of units sold, the sales volume required to earn the target income. Right. So that's target income plus fixed costs divided by unit contribution margin. And we have to multiply that by what? Oh, no, hold on. Oh, no, what happened? Right. Times selling price per unit. Right? So you have to multiply. Yeah. So this is the number of units, and you multiply by the selling price, and that'll give you the amount of money you have to earn, the revenue, the top line revenue item you have to earn in order to get that particular profit you're looking for, the target income. Right? We have one more. Yeah. Which is the break-even sales revenue, which is just a bit of a riff on the top one, right? So the break-even sales revenue. I think I put an I. Wow, yeah. Revenue boy. Oh, did it again. Right. Right. So that's equal to, so again, if it's break even, it means the target income is 0. And 0 plus fixed cost will just give us back fixed cost. So fixed cost over unit contribution margin times the selling price per unit. Right now, there is an alternative formula to that, which we will talk about a little later. Actually, could I just add it in here one time, boy? I think I talk about it later, so I don't want to jump the gun. I'll put it in. Or um, fixed cost divided by CMR. And of course, what is CMR, right? CMR is equal to contribution margin ratio. That is equal to unit contribution margin divided by the selling price. I'll give you guys a whole chunk of information here, right? So, of course, we take our time, right? So, you can think of the contribution margin ratio, like if you think back to regular CSEC accounting, or even your unit one ratios, like your gross margin or your net margin, right? If it's a gross margin, it's a gross profit as a percentage of sales revenue. So here, that's basically what we're doing. So again, under variable costing, we don't use gross profit, we use contribution. So here, all we're doing is we're taking the contribution margin per unit as a percentage of the selling price per unit, right? And that's because technically this is kind of over one, and you could always shift across the denominator. There's a little playing around with maths, all right? All right, okay, cool. Let me take a picture here. So I'll give it a minute or two to kind of settle and digest. So I'm just gonna ask if you guys are good with what's currently on the screen, just kind of give me a quick Genie chat. If you need me to re-explain anything, everything, that's not a problem. But you had to let me know. So if you give me a G, cool. If you give me a R, that's cool still. But you had to let me know specifically. Right? If it's the whole thing, cool. If it's just a particular part of it, if it's one or two lines out of the whole thing, you let me know. All right, I have 12 now. Okay, 12 out of 12. Okay, so somebody pop out. All right. Thank you everybody for responding. All right. Just give me one sec. Um, all right, sorry. Haley is saying, oh no, I don't want that. Haley is saying her internet is giving a little bit of trouble. Okay, let me see. All right, cool. Okay, so now that we've kind of let that settle for a couple minutes there. Okay, so Haley said she can't make because she has internet issues. I'm not seeing Jonica, the other Joshua. Naomi pops in from time to time, so hopefully everybody else will watch the replay. All right, cool. So let us, sorry, hi, is this maths? No, this is Cape Accounting Unit 2, but it is, what we're doing today is a bit math based. All right, okay, so ladies and gents, I'm going to shift across from Excel to OneNote, right? Because I am in need of drawing tools, right? Now, I know I could draw stuff in Excel. I just prefer to draw stuff in, whatchamacallit, OneNote, right? So we're going to talk about the CVP, cost, volume, profit, or break-even point graph, and the assumptions governing the model. All right. So let me just get my where's my oh, sorry. I have to pick a color first, and hold on. Right, let's use that, and we're gonna use these. Oh, okay, okay, that's too far, Christopher. Behave yourself. That could work. Okay, cool. So just give me a couple of seconds to put in some more stuff there. Right. Okay, cool. Thank you. Right. So on the top axis, we have dollars. Right. So let's pull that size a little bit. This, of course, is the origin. Right. If you remember your graphs from regular maths. And of course, we have the units on this side here. Okay, cool. So we're going to put in some, well, as they say, cost curves and revenue curves. Well, a revenue curve, but they're going to look like straight lines. So what we're doing here is we're using what is called the linear assumption of cost behavior. And it simply means cost behaves in a straight line. It's I don't want to say fixed, right? But it's not it's easier for the model, and it allows us to predict things, and then we could then relax that assumption as we go along. All right. Okay, so what I want to do is I want to put in a couple of lines. So give me one sec. So the lines we're going to put are the costs, which are variable costs, fixed costs, and total costs. And we, of course, have to put in a revenue line as well. So let's start by putting in our fixed cost line. So I want revenue to be red, blue, and purple. Right? We could do red, blue, and purple for that. And that one could be in green. Okay, cool. So let's do fixed costs in red. All right. So fixed costs, right? So fixed costs, right, do not increase with output or how many units you sell. So fixed costs. Oh, I should probably use a straight line as well. Let's do that. All right. So fixed costs. Let's go down here too. Right. It's going to be like that. All right. Let's go back here. Sorry. Okay, you could stop now. Thanks. So doesn't want to cooperate, so it's going to go there. I'm going to pull it back here. So that's your fixed cost line. Right. So as you can see, it's a perfectly horizontal line, which means that it's not affected by the number of units sold. So no matter how many units you sell, of course, within the relevant range, the fixed costs remain unchanged. Hence, they're called fixed costs. All right. Now, variable costs, of course, will be a diagonal line. So let's put that one in a blue. Right. Let's get a slightly heavier weight on that line there. Lovely. I'm going to use a straight line. Let's go right to the order. So, of course, if you make 0 units, you incur 0 variable cost, right? And then it's going to rise like that, I guess you could say. Let's go down here. Yeah, let's come back a little bit. Right, and that's going to be our variable cost line. Right, so as you can see, it's a straight line. So again, we assume linear cost behavior, that things behave in a straight line. It makes for, like I said, it's easier for the model at the start. And it simply means that the cost per unit stay the same. They don't vary, right? I know we have things like economies of scale, and we have other other things that can happen that can cause costs to decrease, but we're assuming those things out for now, right? That's a variable cost. Now we have fixed costs, variable costs, and when we add them together, we're going to get total costs, and that is actually going to look like this. So that is actually purple, but this is some. Now the fixed cost line is actually going to be perfectly parallel to the variable costs. Because if you just add them together, all that's happening is you're shifting the variable cost up by this amount here, which is the fixed cost value. All right. This is your total cost. Okay, lovely. Now our revenue line, right? So revenue will be in green. All right. Yeah, I'll use that. Interesting. Right. Now, the revenue line, of course, will again start at zero, because if you sell none, you earn. If you sell none, you earn no money, right? And it's supposed to rise at a steeper gradient than costs, right? Because you need to earn more per unit than it costs you in order to make a profit. All right. This is revenue, total revenue. I'm going to put that here. Okay, right. So we have the red and the blue line. I am. Right. Yeah, sorry. Oops, I forgot to put that. Right. So we have the red, and the red is the fixed cost line. It's perfectly horizontal because it does not increase or decrease regardless of how many units you sell. You can sell no units, you have fixed costs already incurred. You can sell all units, fixed costs stay the same. Variable costs will rise constantly or at a fixed rate with respect to the number of units sold. Again, we're assuming linear cost behavior. We're assuming out things like economies of scale and, gosh, was the other one, boy? There was something that causes cost to decrease in the short term. Anyhow, we'll come back to that. And when we add the blue and the red, we get the purple. All right. So it just, and the purple is simply the blue line shifted upwards, and it starts at where the red line starts as well, right? And again, it's perfectly parallel to the variable cost line. And then the green line, the money you're making, the total revenue line, will of course have a steeper gradient because you have to earn more money than it costs you, right? Now we have a couple of areas of interest here. All right, so I'm probably gonna have to take my pen and do this, right? So the areas of interest that I'm talking about have to do with where, in the first scenario, so let me just get, what do I want to use? I've kind of used up most of my, I didn't use an orange. I didn't use black. Well, technically I used black for the axes. No, I didn't use pink. Okay. Orange, I'm kind of close. Yeah, I'll do it. So yeah, I'll have to use orange and pink. Okay, cool, small thing. What I'll do is I'll use a thicker thing, right? So for the pink, right, if we consider, right, this area here, sorry, one sec. This region of the graph, right? What we'll notice is throughout that area, the purple line is above the green line. And what that means is that at every point between 0 and, hold on, so of course we have to put a kind of a dot there, right? Every point between 0 and that point there, right? Total cost is greater than total revenue. And when you get to that point, what we notice is that the purple and the green line intersect, which means that the values of total revenue and total costs are equal. And that, ladies and gents, is the break-even point. Sorry, I need to straighten that line. Right. So we have losses there. Can I write the word losses? Okay, I'm gonna see if I can overwrite it using a different, yeah. So we have losses being made in that zone there. All right, I mean, you can't see it that well. Sorry about that. Yeah, and then after the break-even point, the green line is above the purple line at every particular point, right? I mean, I do let total costs go on until it hits the top, but total revenue stops there. Okay. Oh, I said orange, right? Okay, cool. Orange. So right, so in that zone there, we have profits. So, all right. I was trying to kind of, okay, so this point here is the break-even point, dollars. This point here is the point units. We could change the font. Why not? It's orange, but that's okay. Okay, so that's our graph. So now we're going to take some notes, right? So where TR is equal to TC, right? That's the break even point. Oh, I think things are flowing a bit better here, boy. So it's probably just in Excel that thing was happening. Where total revenue is less than total cost, right? We have losses where total revenue greater than total cost. We have profits. And like I said, we have the assumptions that we have to list. So in this case, selling price, variable costs, right, and fixed costs are known and remain constant. Right? Did I zoom out a little too much? Yeah, known and remain constant. Changes in costs and revenues are caused only. Hold on, sorry, 1 second. Sorry, only by changes in output and sales, more sales, right? Total costs consist only of fixed costs and variable costs, right? So we don't have anything like opportunity cost factoring in, right? And then linear cost behavior is assumed for simplicity. We ignore things like economies of scale, or improvements or changes in technology, right? Anything that would increase efficiency and cause costs and cause a non-linear behavior, we assume it out. Okay, so I'm gonna take a pic of this page and send it. All right. So while I'm doing that, if you guys are good, please do give me a G in the chat. If you have any questions at all, please let me know. Give me an R. Sorry, just give me where this phone boy. Yeah. So when I thought I had saved up and I said, hey, I'm gonna buy my phone. I'll buy my phone. Yeah, yeah. I ordering online. I have no charges to bring it into Trinidad. And the washer and the dryer need to change. So we're gonna do that today. So I'm going to be with this phone a little while longer. I'm trying to seem ungrateful or give it bad vibes or bad juju. All right. That served me well for the past 7 years. All right. So I have 9 out of, hey, somebody come on, out of 13. All right. So I just sent you a little pic in the chat there. So you can check that out as a piece of notes. I will still send a PDF after class. So you don't have to worry about me not sending that. All right. It will be sent. Okay, I'm gonna go on to the next page. Did I prep that page? Oh, all right, yeah, well, okay, I guess I forgot to delete this stuff, but I guess it's gonna save me some time. So normally I don't like explaining from a static pre-drawn diagram. But I guess I'll make an exception this round. Let's see what comes next. Right. So after this diagram, we're going to get into some workings. Right. I'll do an example, give you guys one to try, and then right, we'll talk again about the contribution margin ratio and that kind of stuff. Is that necessary? Anyhow, yeah. So okay, cool. So let's talk about this thing called the margin of safety, and let me zoom in a little bit, right? So, right. So the margin of safety is basically okay. So when we talk about safety, like how like people who walk a trapeze or do these acrobatic things in circuses have a safety net. People who do stunts sometimes have a safety net or a safety harness, right? So that way, if you fall, you do not get injured or cause a life-threatening, incur a life-threatening injury. And same thing, a business can sustain losses that can threaten and end its life, right? So you want to have like a safety net. So a margin of safety, basically what it is the amount of kind of play you have between where you are currently selling and your break-even point, right? So you are considering, hey, I could sell, the minimum I have to sell is this much here. Like, let's say it was 5,000 units to break even, and I'm currently selling at like 19,000. So in that case, if the minimum I have to sell to cover all my costs and stay in business is 5,000 units, and I'm currently selling 19,000 units, my margin of safety is 14,000. The difference between the actual sales volume and the break-even sales volume as units, and you can translate it to dollars as well, right? The break-even sales value, sales revenue, and the, of course, actual sales revenue. So the margin of safety in dollars is actual sales revenue minus the break-even sales revenue. So it gives you the actual difference. Like how, if you guys think back to your balance sheets, you had working capital or net working capital, which was simply the raw difference between current assets and current liabilities. And it showed by how much current assets exceeded current liabilities on a dollar basis, on a monetary basis, right? If it did, right? And if it didn't, well, we knew we had a problem, right? And then the margin of safety in units is the actual sales volume, which is units, minus the break-even sales volume. So it shows you by how much sales can decrease, whether it's in dollars or units, until you hit the break-even point, right? So let me explain the diagram here, right? If I should draw this over, boy. Okay. Right. So let me try, right? So what I did is I took out some of the lines and I put in some other lines, right? So let me actually take out some of these things so it kind of declutters the visual space. Okay, what we have going on the diagram right now is I took off the fixed cost line and the variable cost line, and I just put the total cost line as the green one, right? And I have total revenue in orange. So I know it's different colors from the previous one, so I'll go back and change it, but let me explain it first. Okay, so it was green and purple. Okay, oops. Right. Now, this point here, where total revenue and total cost intersect or overlap, that is your break-even point, right? So the break-even point, right? If you read across, sorry, if you go from that point across here, you have your break-even point in dollars, and if you read down, that's your break-even point in units, right? Now, ACT is actual, right? So actual. Oh. Right. Oh. So you have your actual. Oh crap. Right. The actual sales revenue is here. So this point here is where we actual. So it's just a created point just for the sake of the example. It's not something scientific you have to work out. It's not some rule you have to know. It's just for the example, right? It could have been put anywhere along this orange line. Sorry, I just chose this point because it corresponded with a horizontal blue line, right? That's the only reason why. So this is the actual revenue we're earning. So ACT is actual, and you read down and as the number of units. Now the distance here. So you're seeing that I kind of double-headed arrow. that distance between the break-even sales volume and the actual sales volume, that is your margin of safety in units. Right? And on the vertical, yeah, on the vertical now, right? This distance, this vertical distance between the break-even point here by the pink line and the actual sales level by the blue line, that distance, that vertical space, that is the margin of safety in dollars. Uh-huh. Oh. Good question. Right, so I'm gonna zoom back out and I'll send the picture. But I don't know if you all want me to put the same colors as before. So green. Okay, so let me change this line to. Can I just change it using that one? No. Okay. Oh, okay. Yeah. All right. So small thing. So yeah. So that is the margin of safety. So that's what it is. That's how to draw a diagram. Cool. Today. Oh, I have no days on. Okay. Maybe that's better. Maybe just take off. No, you know what? Let's leave it. That's fine. Okay. So I'm gonna send a picture of this. Right. So if anyone needs me to re-explain, give me an R. Right. So you can hold on to the G's for now. If you're good, then that's good. All right. One thing. Right. Margin of safety. Cool. We can make in good time. All right. So what we're going to do now is we're actually going to jump back to Excel, and I have some questions copied and pasted. Give me 1 second. I'm going to pull up something. Well, why is that not there? Right. So we're going to jump back to Excel. Onto this page. Now I know it says page 4. That's because page 2 and 3 will be from the OneNote thing with the graphs. I could take off the grid lines. I think grid lines are necessary. Oh. Right. Okay. So what we're going to do, guys, I'm going to go through an example, and then I'm going to give you all one to try. All right. I thought I had more, but I see a whole page here about contribution margin ratio, right? But we did that already. Right. As break-even point in dollars. Okay. Okay. Yeah, we did it. Okay. Yeah. Yeah. So this last page here is a bit excess. So what I'll do, I'll copy and paste that page on. But I kind of did it already. Anyhow, okay. So this is a question from my text from UV that I used to use, right? The Solomon Walter Plunkett and Vargo, accounting the foundation for business success. I don't think it's in print anymore, but I'm giving them the credit, right? So break even and other CVP relationships, right? LOH is learning objectives, right? So Island Escape generates average revenues of $80 for each of its ecologically oriented tours of Oahu, right? So that's I think one of the Hawaiian Islands. So variable costs are $12 per tour, primarily for admissions to scenic attractions and a picnic lunch. Okay, fixed costs total $340,000 per year. So they want to know how many tours must be conducted to break even and what level of revenue needed to earn a target income of $102,000, right? So in the first case, we're talking about units, and in the second case, we're talking about dollars, all right? So what I'm gonna do is as follows, right? So solution, right? So again, how many tours must be connected to break even? So our formula for the break even point, right? So break even point, this item here. See, break even, sorry. Did I not give the break even point formula? Yeah, break even point in number of units, right? So that's fixed cost over the contribution margin per unit. All right. So let's write it out, right? So BEP in units is equal to the fixed costs divided by the unit contribution margin. Okay. Now the fixed costs per year are $340,000. So we're going to put 340,000. Sorry, 1 second. Right, and now the contribution margin per unit is the difference between the selling price or revenue per unit and the variable cost per unit. So that's 80 minus 12. Right? So basically, you're going to have $340,000 over. Now, 80 minus 12 is $68 per unit. And I think that's 5,000. Yeah, because 68 by 5 is 340. Yeah. So that's 5,000 tours. Right? What I will add on here is if we want to find break-even sales revenue, as in a break-even point in dollars, all we'd have to do here is the selling price per unit and multiply it by the break-even point in units. So if we know we have to do 5,000 tours in order to break even, and the revenue per tour, right, is $80. All we have to do therefore is multiply. Right? 1 second, we just tick off a box on this laptop here. Right, okay, sorry about that. Thank you. Right. So what we have to do therefore is take the $80 per tour. I'm going to multiply it by the 5,000 to right? The tours. Is this a business management course? It is cost accounting, cost and managerial accounting. So it does form part of our business management degree. Right, so 80 by 5,000 is equal to $400,000. So the break-even point in terms of revenue is $400,000. Yeah, okay. Get you, right, because it has to cover that and that, right. Yeah. Because you had to cover your fixed cost at 340, and if you're doing 5,000 tours, and each tour has a variable cost of 12, 5,000 by 12 is 60,000. 340 plus 60 is. So that's the next way to kind of cross check it. All right, okay. One sec. Next thing is, what level of revenue is needed to earn a target income of 102,000? Okay, so just to jump back to our formulas first, right? So target sales revenue is the target net profit plus the fixed costs divided by the unit contribution margin, right? And then you have to multiply that by the selling price per unit, right? Or you could do target income plus fixed cost divided by the same CMR thing, the contribution margin ratio. But I'll show you both ways just very quick. Oh, wait, sorry, I went to the wrong thing. Yeah, I'll show you both ways. Okay, right. So what we're trying to find here is the target revenue. And that's equal to selling price per unit multiplied by the target sales volume. Now, right now, we don't know what the target sales volume is as any number of units. So we're going to do a little work in below here. All right. Target sales volume. Volumes? What is volumes? Target sales, well, again, is, sorry, I keep thinking I have to go to our next thing, right? The target sales volume, right, is this item here. Target income plus fixed costs divided by unit contribution margin. Let's go. By UCM. Right. So the target income, according to the question, is $102,000. Right. So 102, and you're gonna add that to your 340. We're gonna divide that by the same $68 per unit. Right. Right. So when we do the math now, right? So let's come on this side here. Right. Can you all see that? Yeah. So I have 102,000, 340,000. I'm gonna add those together, right? And then I'm gonna take that and divide it by 68. I get 6,500. So that's the number of tours that I need to deliver in order to earn my target revenue. So now, yeah. And then now what I'll do is I'll take the 80 and multiply by the 6,500, right? And that'll give us 250, sorry, 520,000. Not 520. Right. Okay. So that's one way. Let me just give me a sec. I have that. Right. So what I'm going to do is I'm actually going to give me a sec. I'll just take that off. Oh wow, I'm on 3 pages now. What's on the third page? Still on 3 pages. Why? Oh, okay. Okay, one sec. No, 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 no. Sorry, guys. Just give me one sec to just kind of. Oh, okay, right. Sorry about all the hullabaloo. So what I want to show you here is kind of easier way to do the second part of the question, right? So as you can see here in the top half, they were asking for the target sales revenue, how much money you'd have to earn a specific profit of 102,000. And as you could see, there were a couple of steps in the working. We had to find the target sales. Now, you could have simply multiplied by the 80 here, right? You could have done that. You could have come right here and multiply by 80, and you would have gotten your answer, right? So, right, the other way to do it is that your target sales revenue is equal to, right? So target income plus the fixed cost. Sorry, it's lagging again. Divided by the contribution margin ratio. Right? Now, no. Right. Let me explain that, right? So the target income plus the fixed cost is the same as on top of it, right? So we have 102 plus the 340. The contribution margin ratio is the ratio of the contribution margin to the selling price, right? So you could even put it like 68 over 80, right? You could put it like that, or if you simply divide, right, 68 divided by 80, we get 0.85. So it's a 0.85 contribution margin ratio, so 0.85. we do that, so let's check that, right? So if we take the 102, add the 340, 340, thank you very much. No. Right. So that's the 442. And if we divide that by that, look at what we get. The same 520 as on top of there. It's just in a more compact working. Equal to divide by equal to what was it? It was 68 divided by 80, and that's equal to 0. Wait, I have 0.8 instead of 80. My bad. Right. So that is the alternative way to do part B. Right. As you can see, it basically just takes this. Now, again, you could do this as a one-liner. We didn't have to work this separately and then multiply it by 80. We could have multiplied it by 80 right here. All right. Or we could have done it this particular. So again, sometimes in certain instances, they will give you outright the contribution margin ratio, in which case it makes sense just to use the shorter one. But neither of these is more correct or less correct than the other. All right, so let me just zoom out a little bit because I want to send that in a pic. As a pic in the chat. Okay. Oh, lovely. So let me do that real quick. What? No, thank you. Very good, very good. Right, so let's just recap that, and then I'll ask you guys if you're good with it, right? So Island Escapes, right, generates average revenues of $8 for each of its tours, right? So that's the revenue per tour. Variable costs are 12 and fixed costs are 340 per year. Okay, so what do they want us to find? The break even, how many tours must be conducted? That's how many tours is the volume, the number of tours, and the number of units. So they want the first thing they want is the break even point in units. Simple formula is fixed cost divided by contribution margin per unit, also known as unit contribution margin. Fixed cost 340. So you take 340 and divide by the unit contribution margin, which is the selling price or the revenue per tour minus the variable cost per tour. 80 minus 12 is 68. 340 minus 60 is 5,000. Long story short, right? Now they didn't ask for this line here. Yeah, they didn't ask for this information here, but I give it as a bit of an extra. All right. Okay, well, now the next thing they asked for was the target rev. So what level of revenue, how much money do we need to earn in order to get a profit of 102? Right. So for that, we have a formula, right? So again, you could take it straightforward. You could say, okay, look, I'm going to take my selling price per unit and multiply by the number of units that I have to sell in order to make that revenue. Now, we came down here to find the number of units, which is the target revenue of 102 plus the fixed cost of 340 divided by the same $68 per unit, right? That gave us 6,500 tours. And we then took the selling price and multiplied it by the number of tours. Right? Now, again, we didn't have to do this in two separate lines. You could have simply put multiply by $80 right here. And then it would have just compressed the working into one line. Right? Alternatively, target sales revenue, right, is also given by this same thing here, target income plus fixed cost, but now divided by contribution margin ratio. What is that? That is simply the ratio of the contribution margin per unit to the selling price per unit. It's like a gross margin. All right. But like I said, under variable or marginal costing, we don't have gross profit. We have contribution margin. All right. Okay. So that's the first question. As the example, sorry. All right. So guys, if you all are good, just kindly give me a quick G in the chat. If you need me to re-explain anything, give me an R, and you can put you could tell me or type out what it is, or you can put part A or part B, or if there's any specific aspect. Just give me 1 second to see the dog barking at. Oh, I forgot to finish my. Oh. Okay, cool. Lovely. That's 6. So that's about half of y'all. The next half, I'll let me know what's going on. All right, so let me just check something real quick here. Oh, right. So I'm gonna give you guys a question to try, and I have to make a quick call to my teacher, Mr. Cooper. He's supposed to have a class at 1, but I know he was not well this week, so one of the boys messaged in the chat, but I didn't see him. I didn't see Mr. Cooper respond. Right? Okay, so I'm gonna just zoom in here a little bit. Right. So this is also from my text. So this is Century Manufacturing produced and sold 70,000 pressure gauges at $32 each. This level of activity amounted to 70% of the firm's total productive capacity. Is there a question? Right. The costs related to the pressure gauge line were as follows. So we have variable manufacturing and selling, and fixed manufacturing, selling, and admin. So we have fixed costs. Okay, cool. Oh, they didn't have any requirements. Okay. Put the requirements. No problem. I can do that. So the first thing they want is part A. They want the break-even point in units. B. They want the margin of safety as well. The margin of safety in dollars. All right. So here what to do. Do the first part for me. All right. Now, to do the first part, right, you'll have to figure out the variable cost per unit, right? Now, they've given you the total variable cost at the 980, and we know how many units we created with that particular cost, which is 70,000. It's in the top line for the first sentence of the question there, right? So you probably just want to divide. Okay, so do that. All right. Okay. Cool. Sort out. Oh, there you go. Okay, we're going on, boy. You're on. Right. Let me just respond to Logan. What can tag him here? Hi, Logan. Right. Okay. So the break-even point in units. Actually, let me give you all a minute or two again, just in case. Yeah, because after that, does it? First page I noticed. I guess maybe I started late last year, and then after that, it was straight to the past paper questions. I feel we could get through at least one or two. And maybe if we do that, I could actually just send you guys last year's replay. We ought to go through those the other questions, and then we could even move on to our next topic next week. So here's what we'll do. I'll pull up the past papers just now. We'll see how many we could get through. I think we can get through at least two or three of these. Yeah. And yeah, I'll send you guys a. I'll send a poll in the chat if you guys want to just get the replay with the other few questions I did, and you just watch those on your own. And then next week we move on to budgeting. Right, we could do that. Or if you all want to save the questions for and do a session specifically next week on past paper questions in break even point, we could do that too. Right. So we'll see what the poll reveals. Okay. Oh, right. So the break-even point in units is equal to fixed costs divided by the unit contribution margin. Right? As we saw, the fixed costs in total are $810,000. Right? So $810,000. Now, the selling price per unit is $32, right? So it's 32. And we have to minus the variable cost per unit. Now, the variable cost per unit, we have to calculate, and I'll show you, right? So we sold 70,000 and the variable cost incurred is 980 divided by 70. I mean, you could do the working in the working, or you could do that little extra working outside someone. But you had to make reference there, right? So long story short, we're gonna have $810,000 over. Wait, you know what? Let's leave what the dollars is. That's 32 minus 14. Right? So that's equal to $810,000 over 18. That gives us actually 45,000 units. Can I get a quick G in the chat if you guys are good with the first one there? If you need me to re-explain or recalculate, let me know. Please and thanks. Cool. Right. Okay, cool. So now, margin of safety. So I know we just kind of briefly mentioned it. So that's the number in units, right? So we sold 70,000 and the break even point is 45. So 70,000 minus the 45,000 is equal to 25,000, right? Dollars, right? So so what we could do here, you could simply multiply that 25,000 by 32, right? If you want to do the long way, you can multiply each of these by 32 and then, well, subtract, right? But long story short, it'll be more efficient to just take the break-even point in units and multiply it by the selling price per unit, which gives us $800,000. Okay, cool. All right, so that's the margin of safety calculations, right? Okay, so like I was saying, the next page that I had a whole set of stuff on like the contribution margin ratio thing, and I don't think it's terribly necessary. And we have a half an hour again, and I don't really want to waste it. So I think that what we're going to do is I'm going to pull up a couple of possible questions. We're going to go. I'm going to give you guys a chance to do them. Obviously, we're going to correct them, and then uh, we'll end there. So let's do that. Okay. So let me pull up my past paper questions. Where did I close? Oh yeah, I did close it off. Yeah, because you know what? You know what I could do? I could simply close off this item here. That might be taking up some memory. Yeah, it is. I know exactly why. Because I have a mass thing that open. It has a lot of images. Right. All right. So where are my PPQ? PPS. Past paper questions 2019. Go back. All right. Hold on. Let me see. Yeah. Because it was a 2022 one with what you call it, the limiting factor. But I think we would have done that back in December. Okay, I believe I clicked enter for it to open. It's taking a little while. I don't know why. Oh, that's why, because I was closing this off. Okay, cool. Yeah, and I did update it already. Okay, cool. So we could, yeah, and this was the last page. So I'll send you guys this page as well, but it's not something you have to go through. If you want to, you could. Um, right. So that's that's 2022. I think we would have done this last year. Right. Okay, so this is 2019 question. All right, so let me zoom out a little bit. I'm gonna send a picture. Sorry, I just need to send a quick message. Oh, I'm now seeing your picture. Sorry, I didn't see it before. I haven't put that. Just send a quick message. My son apparently got stung by a bee. Um, hey, morning. So Shiloh was outside. He got stung by a bee. He doesn't seem to be in any pain or bothered at all. But someone just wants to know if we should still give him Puritan, just in case. So, any thoughts? Thank you. I have a friend who's a pediatrician, and she actually has chicken pox right now. What was the other one? Sorry, I'm gonna send this to three people. Hi, morning, doc. So Shiloh was playing outside and got stung by a bee. He didn't cry. He didn't actually seem bothered. Well, given the fact that when you gave him the shots last time, he barely flinched. But my wife just wants to know if we should still give him Puritan just in case. So if you could let me know ASAP, that'd be great. Thank you. Ikran, morning. Quick question. So Shiloh, my 2-year-old, 2.5-year-old almost, was outside playing and he got stung by a bee. It didn't seem to bother him much. He seems perfectly fine. But my wife just wants to know if we should still give him Puritan just in case. If you could let me know ASAP, that'd be great. Thank you. Okay, right. Let's take a read here, guys. So, Unique Design manufactures product 753. The company has budgeted to produce 650 units to be sold for $23,000 per unit. Okay, that's clearly the selling price. The following standard was established. So this was right. So materials, labor, variable overhead. Okay, so these are variable costs, right, per unit. This is the fixed cost. The following actual costs were incurred during the last quarter when 600 units were produced. People don't read back or check, whatever. Right. So direct material purchased, that direct labor, variable overheads. Okay, cool. Right. So I'm now thinking maybe this is not the best question to start with because we have some real weird looking figures here. Yeah, let's go to Spencer. Right, Spencer's a nice looking question. Looks quite easy. Right, so Spencer Manufacturing produces dining tables and chairs. The selling price for each set of table and chairs is $250. That's the selling price. Variable manufacturing cost is $158 per unit, and variable selling cost is 4% of the selling price. 4%. Annual fixed manufacturing cost is this. Calculate break-even point in units, break-even point in dollars. Okay, right. So I'll give you like a 5 to 7 minutes. So please go ahead with that. Thank you very much. Oh, just so you know, this is the 2017 question. Oh, thanks, Gabe. So I just want to talk through a couple of things real quick. Right. So the selling price is that. Variable manufacturing is 150. Variable selling is 4% of that. If you knock off two zeros, that's going to be 10,000. Right. 10,000 is the variable selling cost. So to find contribution is selling price minus all variable costs. right? Which is 158 for manufacturing and 10,000 for selling. It was 2017, right? Okay, cool. Let's zoom out a bit. So I'm just gonna kind of talk through something. If you're still working, that's perfectly fine, right? The calculation, the break-even point in units is the fixed costs in dollars, right? Divided by the unit contribution margin, which is dollars per unit. Right? The fixed cost they gave us was the 25,420,000. Right? But we don't have the contribution margin outright. So what we need to do is calculate it, which is the unit selling price or selling price per unit, which is the 250 minus the variable cost. So we have variable manufacturing costs, right? So that's 158, right? And then we have less variable selling costs, which is 4% of selling price. Right? So when you add up, when you subtract going down, you're going to get the 82,000, which is the unit contribution margin. Right? And then this there, and we're going to divide. So is this divide by that? Boom. So 310 units. So this is the break-even point in units. This is the UCM. Oh, sorry, I will check it. Just give me a couple of seconds. Right, so they want, so that's the first part. The next piece that, right, the next piece they want is the break-even point in dollars. So I'll give you a couple of minutes if you're still working it, right? Why do we need so much space there? let's go. Right, so the calculation of the break-even point in dollars, right? So you could do it a couple different ways, right? You could simply take the break-even point of 310 units, right? So this is oh no, that's fine. Yeah, so you could take the break uh, units, which is equal to 310, and multiply by the selling price, which is 250. Right? Selling price per unit or unit selling price, which is equal to 250. Right, and then just multiply that, multiply that. Right, so $77.5 million to break just to break even. Wow. Right, the other way to do it is to do fixed cost divided by the contribution margin ratio, which is the ratio of the contribution, which is 82,000, right? Divided by the selling price, 250,000. Right, so 82,000 divided by 250,000. Right, and then the fixed costs, 5.42 million. Divide, you get same $77.5 million. Right, let's maximize that. That's 2017 Spencer Manufacturing. Let's pick in the chart. Right, can I just get a quick G in the chat if you guys are good with that, please and thanks. To re-explain, that's not a problem. Wait, did I not send a picture of the second one? Okay, sorry, give me 1 sec. I forgot to send a picture of this. Okay, cool. Okay, cool. Next question. Let's tackle 2014 next. Let's zoom out a little bit so you can see the whole thing. Okay, so this one, right? So Macintosh makes one product, and its factory has a capacity to produce 200,000 units of product that year. Right. The budgeted income statement is as follows. So sales 150 by 75. So 75 is clearly selling price per unit. Direct materials, direct wages, production overhead variable, distribution overhead variable. Okay. They want the break-even point. Right. So they want the break-even point in units and dollars. The margin of safety also in units and dollars. Right. So I could give you guys about 10 minutes to do this one. Then we will probably stop there for the day. Right, and what I will do is I'll send you guys a couple other questions to try, which is just 2 more. Yeah, we're basically done with CVP. It was a 1 day thing, boy. What? All right. I think I've ever done it in 1 day. Anyhow. point is now just talking through some stuff, just in case anybody's stuck. So fixed costs, I see in two sets of fixed costs there. I see in production of 1.25 million and distribution of 500,000. So your total fixed cost is 1.75 million, the 1.25 plus the 0.5, right? And of course, your contribution margin per unit would be the selling price minus your variable cost per unit. Now, we have variable costs, materials, wages, variable production overhead, variable distribution. So if you add up all of those, so that's right, 5.25, 5.55, 6.45. And we would divide all that by 200,000. It's 200? No. 150. Ooh, I get catch. Because you only sold 150, right? Your car base is only 200, is 150. Wow, I get catch. Wow. Accounts, that's correct. Yeah, so you see how easy you can get catch if you don't pay attention to what you're doing. 150 is the actual figure divided by to find it per unit. Looking like I have the wrong figure here because we have a variable distribution overhead. No, I have that. So what am I? Production. So why did I not put that in? 2.253 million variable overhead. Yeah, okay, I'm gonna have to modify my answer clearly because I'm looking at my answer from last year and I have the materials, I have the wages, I have the 900, but I don't have the 300. I have no explanation as to why. All right. I'm gonna start starting. So that way I'm not doing anything on top of that. Right. Okay. Cool. So I'm gonna go to 2014, which is Macintosh. Right. So I'm gonna do over this calculation of contribution margin per unit. Right. So I'm gonna change this to 1.2 million, which is the 900 plus the 300. Right. Selling price is 75, which is given to us here. The materials, right, is 2.25 divided by the 150. The 150 is the number, right, of units, sorry. Direct wages is 3 million divided by 150, that's 20. And then the variable overhead, so I add the variable production and variable distribution. So 300,000 plus 900,000 is 1.2 million. And then 1.2 million divided by the same 150 is 8. 15 and 20 is 35. 35 and is 43. And then 43 from 75 is 32. Then we're going to take the 1.6, so the fixed cost, so the 1.25 plus the 500 is 1.75 divided by 32 is 54,688. That's what I got. If you guys got anything different, let me know. Now they want the margin of safety. So the margin of safety is different. Sorry. And they want the break-even point in dollars too. So you're going to take the 54,688 and multiply by 75. Right? So I got about 4.1 million. Right? Contribution margin ratio. Right. So contribution is 32, right? Contribution margin ratio divided by this. Yeah, so you got the same 4.101 million. The break-even point in dollars. Now the margin of safety is the actual sales level. So like 150 minus 5468, right? 150 minus 54,688. Sorry, I said 660, didn't I? 95,313. And then in terms of the dollars, it will be oh, well, I just took that and multiplied it by the 75. But you could have taken this 11,250. See? Equal to 11,250 minus this. 7.148. Yeah, 7.148. Right. So I'll send a picture of that in the chat too. Okay, well, I guess I'm going to have to send 2 pics of this one. Okay. Sorry, right. Okay. Right. So let me send this pic. One and the last one piece here. Right. Okay. All right. So, folks, ladies and gents, that's about it for today. Right now, I guess I must have started late last year, and I guess in omitting the extra explanation behind the contribution margin ratio thing, I saved some time, right? So we basically finished with this topic, right? There were only a couple more possible questions. The 2009, 2019, which was a little more involved, and the 2022 was more of a that was more of a limiting factor question. I'm not sure why I have it here, to be honest, right? This isn't supposed to be here, right? So I'll send you the past paper questions and the solutions so you guys could try 2009 and 2019. But other than that, that's it for break even point. So that means next week we could start budgeting, to be honest. Yeah. Right. So if anybody has any questions and they get to ask during class, please feel free to message me. Other than that, have a good weekend and I'll see you guys next week. Bye. Later. All right, bye bye. All right, guys. Take care. Later. Okay. That's cool. All right. 3 people on YouTube, thanks for tuning in. I'll see you guys. Next week, Saturday, 10 to 12, is the usual Cape Accounting Unit 2 day. The Unit 1 class is not taught by me, and unfortunately, it's also not streamed. So there's nothing for that. But I do have the replays of my Unit 1 class from a couple years ago on my school.com community. It's a small membership fee of 200 TT per month, which is about 30 US per month. And you could actually just watch for 1 month and then cancel the subscription, right? You can cancel at any time. All right. So if that's something you're interested in, you could always message me on Instagram or email me.